Hey everybody, John Felici, Security National Mortgage Company. Hey, it's Friday, it's a good day. And what we're going to talk about today is something, a friend text messaged me the other day and they asked me this question. They said, I see these guys on HGTV, and they go in and they buy a house for X amount of money and then they allocate so much money for repairs. And it's like, well, how do they do that? How can I do that, more importantly? So we're going to talk about flipping houses. The first thing that you do is you take the house in your hand and you flip it. There, see, it's not really that hard, to flip houses, but no, seriously. The truth of the matter is with flipping houses, I've worked with lots of different successful real estate investors over the years and the time that I've been doing this. And, the most successful real estate investors that I've seen, usually they have the cash on hand to be able to go in and purchase and renovate homes. Other situations with other real estate investors, they might have a long-standing relationship with a bank, and so they have like a line of credit. So for example, they're going to auction where, maybe foreclosed homes are put up, for sale, and they get those homes at a discounted rate. And then they, have their line of credit at the bank waiting on them to purchase the home. And then, they get something similar to like a construction loan, where it's like, they'll draw on the loan to be able to do repairs. And that loan is usually put on some type of interest-only payback for maybe short-term, 6, 18, 24 months, enough time for them to be able to obtain the home, do the repairs, renovate, and then put it back on the market and sell. Now, in those kind of situations, those are the kind of people that have been doing this for a while. They've got a lot of capital, and so it's really a situation that most people starting out you're not going to run into, because you need to get these types of loans. You're going to need very good credit. You're going to need money down, collateral, etc., etc. Now, for most people who are going to buy like investment properties. Now, with secondary market lenders, which that's what Security National, that's what I am, that's what probably 99% of the mortgage lending that goes on in the United States. It's a lot secondary market, and what that basically means is that the loans that we do, Security National and many other lending institutions, they all conform to a minimum set of guidelines described by the government, so that our loans can all be interchangeable, so that we can sell them on the secondary market, and that's where a lot of the big money is made. So for that reason, everything has to conform to that minimum set of guidelines, and as long as it does, you're okay. Now, within my type of financing and a lot of other type of lenders financing, you have loans where you can buy investment properties, like a second home, or a home that you're going to use strictly for an investment property. Now, this kind of loan, generally speaking, you're going to be putting in excess of 20% down on the house, so that excludes a lot of people right there. The other thing is that, generally speaking, when you're talking about like a conventional loan for an investment property, most people when they're thinking about buying like a flip house, what everybody has in their head is that they're going to go out and they're going to buy like a dilapidated home that needs a bunch of repairs. They're going to get, 10 or 15,000 bucks in their pocket, and they're going to be able to go out and, use your brother for the tile. You got a discount with your buddy over at the granite place, and so it's like you're going to pool your human resources together, use the money that you've got, and you're going to fix that place up, and then you're going to sell it at a profit, or rent it at a profit, or whatever you want to do. But, a typical purchase money loan for a non-owner occupied property doesn't really work that way. First of all, the home is not going to be able to be in a state of total disrepair. It's going to have to be in a livable condition. You're not talking about like Property Brothers or the flip shows. I don't watch those things. My wife does. I don't watch them, okay? So it's like I just hear little tidbits here and there. But I've seen a couple of them where those guys, they go bust in the door and there's like 6 bums living in the house, and heroin needles laying everywhere, and they clear it out and turn it into a beautiful property like 3 months later. Well, that's not the kind of loan. Sorry, I had a phone call. But that's not the kind of loan that you can get for like a non-owner occupied property. You're talking about buying a home that is existing and livable and everything else. Now, The way that I would probably recommend, I mean, for most people, if you're out there and you're looking at trying to get into property flipping, things like that, really it's the kind of thing where you want to start out small, so for example, it's like you can go online, you can find lots of little houses, $10,000, $15,000. These are the kind of houses that can maybe fix up for, fix up for $5,000 or $6,000 or $8,000. And then it's like, you could turn around. In my opinion, I'm not the kind of person that would want to be a landlord on a property. So it's like I'm not too interested in renting a property. I think it is more enticing to fix something up and then sell it and make a chunk. But it's like the most successful real estate investors, going back to that I've seen, they have the cash on hand, or they have connections, within lending institutions to be able and get, short-term construction type loans to be able to pull money and, buy property at auction when it comes available, and then, draw on the loan to do the repairs, and then, have that loan for a short enough time or long enough time to get the property sold. But like I said, if you're not working with that, you could start small. It's like, you buy the smaller houses. I mean, save up $10,000 or $15,000. You buy a place that's structurally sound, or at least close to it, and you go in there and go in wood laminate. Get some good countertops, new carpet, things like that. Stuff that doesn't cost too much. And it's like after a couple of these type houses, you can pool up $5,000, $10,000, $15,000, $20,000, and it's like from transaction to transaction, you're just going to keep getting a little bit more and a little bit more. There's also, the 203K loan, which a lot of people have questions about. 203K, I mean, it's a good product for the right circumstances, but generally speaking, I mean, I have not seen much of them work out in a way to where it would be beneficial to do like property flipping or like an investment property. First off, you're doing the 203K loan as a primary residence. So, I mean, it's not really up to the lender though. I mean, once you close on a house, I mean, potentially the home that you own now that you finance as a primary residence, I mean, you can potentially rent your home out, and, after your loan is closed whenever you want. You just have to intend to live there, at the time of closing and beyond. So it's like with a 203K loan, it could potentially turn into a rental property or an investment property if you do the right angle. But the way that a 203K loan works is, for example, you find a home, and maybe this home is in like I said, a state of disrepair. It needs some work. So what happens is you go in and you're going to put a bid on the property, and then, you are going to get contractors to, give estimates on what the property needs. So let's just keep it broad here. Let's say that, whatever it is, it's invoiced out at $20,000 or $30,000. The sale price on the home is like $80,000. So let's just say 20 to make the numbers easy. So then, you need a total of $100,000 to be able to do this loan. But the thing is with doing that is it's like the repairs, going back to what most people assume, when you think about doing an investment property, most people are wanting to do the repairs themselves. They picture it in a way to where they're going to get the money in their hand, and then they're going to be able to go in there and do the repairs at their leisure, and then it's all going to be good and they sell the property. Well, with like 203K, like I said, the repairs are going to be invoiced and completed by FHA-approved contractors. And so the way that I describe this to most people is it's kind of like doing your home renovation at Lowe's. You're really paying retail whenever you do this. So then after the repairs are done, the contractors will draw on the escrow account from the 203K. They'll draw on that to complete the repairs, and when the repairs are done, they're inspected, by the appraiser, the inspectors, and certified that they were completed in accordance with, the invoices and that everything went to plan. So then at that point, the remainder of the money is released and the loan officially closes. So, the problem with that is that if you're trying to do it from like a way to where you're going to have a lot of equity on a home, I mean, when you're doing your repairs for retail, you're not able to really be involved in it, then it's a lot harder to, have the maximum profit or equity, I guess, on a 203K loan that you could have. So, back to the simple answer. when you see these people on the property flipping shows, HGTV and whatnot, these people most likely, they're doing one of two things. They either have several $100,000 backing them up to be able to purchase homes and do the repairs and then move on to other homes, making chunks along the way and building their assets. Or it could be somebody that has a long-standing relationship with a bank where they have the access to be able to go in there and borrow money as they need it to purchase and repair homes. So, you know, for the majority of the population, you know, it's the kind of thing where you want to start small. Save up $10,000, $15,000. You know, you're going to find a home and, you know, try to be smart with what you need to do to it. You know, don't go overboard, keep it simple, and, you know, sell that place, make $10,000 or $15,000, and then buy another one. And you move on, and as you go, you're building up more collateral, and you can do more things. But, you know, the main thing that I wanted to explain is because I think a lot of people have a perception out there that there's not really any loan on the secondary market or in the majority of the lending world, you know, that's going to allow you to purchase a dilapidated home and then give you just money out on the side so that you can go fix it up and, you know, sell it and make $1 million. Just doesn't work like that. But, you know, I tell you this, I've had a lot of experience with different real estate investors over the years. I have, you know, seen their transactions time after time from the, you know, point A to closing. I see how much they make. I see what they do. And it's like, I could probably be very useful to you if you're looking into doing this. I mean, I have a lot of pointers, a lot of insight, you know, in the real estate investment world, and I'd be happy to share that with anybody if you have any questions. You can reach me at 918-630-1991, or you can, who's that? Overbuild. My wife made up a good point there. Overbuilding. So forget my phone number, we'll come back to that. Overbuilding. Let's just say that, you know, you want to do awesome rental properties, okay? And you found a home in a neighborhood of homes that are probably appraising for like $100,000 or $115,000, and you got a good deal on this place. You got $75,000, okay? And so you want to go into this place, and you're like, you know, I'm the kind of real estate investor. I want my house to look nice. I want it to be great. So you go into this neighborhood with a bunch of homes that are $115,000, and you know, maybe these homes all have Formica countertops. You know, they got regular tile in them. You know, it's like maybe not updated carpet, et cetera, et cetera. So it's like you go in, and in your house, you want to put granite in it, okay? And maybe you want real hardwood floors, not wood laminate. So it's like you spend the extra money, but the problem is that if you're going into a neighborhood where there are not sales to support what your value is, what you're doing is overbuilding. A good analogy would be, if you take a $50,000 solid gold toilet seat and put it into a house, it does not make that house worth $50,000 more dollars. In order for that house to be worth more, according to the toilet seats, you're going to have to find other houses that have golden toilet seats. So good luck. So with that, you know, overbuilding. That's why I was saying, it's like, you know, keep it simple when you're doing investment properties. You know, make them nice. You know, I'm a real big believer, you know, it's like, you know, the granite is good, it's durable, you know, good tile, wood laminate, things like that. Just stuff that are not going to run your budget up, because, you know, if you make a house too nice in a neighborhood where there's nothing to compare it to, it doesn't mean that your house is going to sell for more. So once again, I mean, I've got different little pearls of wisdom. If anybody would like to pick my brain or get any ideas, feel free to give me a call, 918-630-1991. You can also reach me via email. My email address is jon.f.like-frank, L-E-E-G-E, @snmc.com, as in Security National Mortgage Company. John.Fleege at Security National Mortgage Company. 918-630-1991. Hey guys, I'm out of here. I'm trying to get out of here soon. I'm going to exercise. I'm going to go hang out with my hot wife and my crazy little kids. So everybody, I hope you have a good weekend. I'll see you soon.